Hello, everyone. If oh, excuse me. Oh boy. Sorry. I've been here for probably about 30 minutes trying to get a few things done before class started. Um, Hope everyone's doing well. If you can do me a favor, if you send me a chat, just to let me know how you guys are doing. Because very few people are sharing anything other than just the fact of their names here. So, it'd be nice to hear that everyone's doing well. Let's see. Main monitor. There you go. All right. Okay. Oh, all right. Ugh, excuse me. I'm sorry. This is killing me, I guess. Yeah, so there's a couple things that I wanted to talk about before we get too far into the class. And actually, what I'm going to do is I'm going to pause sharing of the screen while I do this, just so it looks a little bit more personal. Um, Here's kind of the whole thing. I know I kind of dropped the test on everyone, and I'm sure that there's probably a lot of people who are in shock with how the test is. Um, I want to make sure that I make it absolutely clear that look, first of all, I know that the test looks like a lot, but it's I don't think that people should be looking at it as how difficult it is, as much as they're people should be able to see that what it's going to do. Okay. It's kind of like the elephant. You can eat an entire elephant if you just take it one bite at a time. And that's kind of how this needs to happen. Now, I'm sure some of you are looking at it and saying, how am I going to manage all this? How am I going to fix all of this? One of the things that I'm going to be doing when I have the office hours, which is what I put in the email, which we'll have it at, we'll have those office hours at, I think it's 7 o'clock tonight. Then I think I chose 4 o'clock the following Thursday. And I mean, all I'm going to do is I'm just going to hop on my computer. I'll probably have it at home just because of the fact that, my wife is actually asking me to come home at somewhat of a regular time now that tax season's been extended, just for a little while. But the whole thing about this is that, when we have the office hours, I'm going to talk about some techniques and some plans of how we're going to do it. And then the other thing is I'm willing to answer questions. Normally on a test, I know professors don't normally do this, but I'm willing to answer questions that you might have with regards to the test. So, if you show up to those office hours, you're going to be able to ask those questions. Now, something I'm thinking about doing is I'm probably going to record those sessions also, and I'll make them available. That I don't have any problems making available, but I think that, if you have any questions that you need to have answered about the test, you're going to want to show up and make sure that you can actually get those questions addressed. My goal was not to make the office hours, for, like, I don't want to be here every single night answering questions about the test, because I think that's not going to be very conducive to. First of all, I don't know if I got that much time, and then second of all, I think it's not going to be helpful for you guys because we're going to be scheduling so many different things all at once. Excuse me. Sorry. No, I don't have the virus. I just had something a little dry in my throat. But the one thing that I do think that would be very helpful with these office hours, like I said, you can ask anything. If it's something that I'm kind of like, yeah, that's probably something you should be able to figure out, I'm going to tell you. But I mean, I'm going to be pretty open with a lot of this stuff. Okay. My goal is to help with these office hours is kind of to discuss more techniques of how to answer some of these questions. Now, obviously, like a lot of the multiple choice questions or the definitional questions, a lot of that stuff you're going to be able to do on your own. But I think that, the one thing I'm mostly concerned about is the sale of the rental property. That's part of the test, and how you would want to present that. And I can actually show you a work paper or two that I would have designed to answer this, and how we actually use these work papers in our firm. My goal is to take this test and kind of give you an experience, so that when you go work at your first firm and they come to you and say, hey, so and so just sold a rental property, you're going to be able to walk into that with confidence and say, yeah, I know how we can answer this, and this is exactly how we're going to do it. And by doing it that way, what will happen is that I think it's going to set you up for more success than just simply answering questions about what's 1231, what's 1031, what's and all that sort of stuff. Obviously, there's some base knowledge that you have to have in order to be successful at a firm, but I think that there's some opportunities here with the distance learning and the forcing of doing take-home tests that we can do something a little bit beefier that will give you some mad skills that when you go in and somebody says, hey, this client just sold their property. Are you afraid to tackle it? And you're going to say no. And then I think it also helps you a little bit kind of understand some of the concepts. I remember when I was taking the CPA exam, I kind of did what we called in the military pump and dump. You pump all this knowledge into your head, and then once you take the exam, you just release it, you dump it, so that you can clear your brain, so that you can go pump more knowledge in there about some other part of this section of the exam. And a lot of times, like for example, when I took a look at 179 versus 168, I couldn't understand the two. I'd never really seen it. And it wasn't until I started working at the firm and having to deal with some of these issues that people came to me and said, well, why would I take 179 versus 168? And it wasn't really until then that I started seeing some of that. I would also say that, I didn't really fully understand the concept of how to calculate gain and losses on the disposal of a building or of a property, a real property, until I actually sat down and did it at the firm. The CPA exam will give you a lot of terms. They'll give you a lot of terminology, not terms, sorry. They'll give you a lot of terminology. They don't really teach you a lot of methods of how to do these on, in real world type applications, because the CPA exam prep guys, they're just trying to get you to pass the test. That's it. So my goal is that, like I said, for those of you who just joined, I noticed we picked up probably around 7 or 8 people. We're going to have the office hours tonight at 7 o'clock. I will be answering any questions that anybody has about the exam. My recommendation is that, if you haven't taken a look at the exam, take it, download it, read it, go through it, see how you're going to answer some of these things. And then we'll kind of talk a little bit about some of the methodologies that you guys can do to get stuff done. And then also I'll talk about how I'll have you how I will have you guys turn in the exam once you're finished with it. So first of all, I want to say to everyone who says good morning, thank you very much. I appreciate it. It's nice to know that there are actually people out there. The other question that I do want to ask, and this is going to sound like kind of a weird question. When you guys downloaded for the GoToMeeting app, did they make you put in any personalized information? I'm just kind of curious for that. And you guys can respond to me by text. Like, did they ask you for like your name, email address, or any of that stuff? Because I don't think they were supposed to, but I just want to make sure that was not the case. Okay. Okay. No. Okay. Good. Because I had this tool was not something that the university provides. It's something that I own. I actually pay for this. The concern that a lot of people have is that they don't want your personalized information to be taken and then sold on the to third party vendors. And I think that's the biggest concern that they've had. And I'm like, look, I pay these guys almost $50 a month so that I can get access to this stuff, and they're not supposed to be doing any of that. And so I just wanted to make sure. And if they're not even collecting it, obviously there's no way that they're getting it. So. Okay, so I'm going to go ahead and I'll start screen sharing again. Uh, but let me see here. All right, so we're going to talk today about retirement plans. And kind of the cool thing about retirement plans, this class, there are two classes that we have, and look, I did some reflection on how the Chapter 12 class went. I wasn't very happy with it, mostly because this class, when I usually plan the classes that we're going to do, I actually will take and uh, what I do is I tend to sit down and I tend to think about how these classes not only apply from a tax perspective, but how it can help you in real life. Okay. So when I plan to do chapter 12, when I plan to do chapter 13, it's supposed to be a far more interactive class where we talk about various things that, like I said, I know that there's several of you that are going to make a choice not to work in the field of tax. I can respect that decision. I'm kind of sad to hear that, but at the same time, I think that there's, I think that there's a lot of stuff that that you will experience in chapter 12, chapter 13, that even after you leave this course and you go off and you go work in the corporate world, that you're going to be sitting there kind of going, gosh, I'm really glad I learned a little bit about this because at least it helped me make some choices in my life. Um, that's kind of what I've been trying to do with a couple of these classes. And so we're going to talk a little bit about this from chapter 13, the savings, retirement savings and deferred compensation. We're going to obviously talk about the tax implications of it because obviously it's a tax course. But the second thing that we're going to do is that I really want to talk about this from a perspective of personal finances also, to kind of give you guys some help with making good choices in your retirement savings. So the first thing that we're going to talk about today, of course, is the employer provided qualified plans. So qualified plans, there's really two main types that they like to talk about. And then you have this defined benefit plan and you have this defined contribution plan. And if you really want to think about what the difference between these two are, the primary difference is that it's number one, who bears the risk, and number two, who's the primary contributor of money. Okay, because in the defined benefit plan, the primary contributor of the money is going to be the company. Okay, the company will set aside money in order to provide for retirement for its employees. The other, with the defined contribution plan, the primary contributor is going to be the employee. All right, you can contribute, in a defined contribution plan, you can contribute up to a specified amount. Very common for a very common defined contribution plan is a 401k. You're allowed to contribute this year. It's $19,000, and then if you're over the age of 50, they'll throw in a $6,000 kicker to $25,000, and so you're allowed to do that. But the question of the day, that's most important, aside from who contributes the money, is also who bears the risk. If a defined benefit plan is not funded correctly, the employer is the one who is actually at the risk here. Okay, so say for example, you work for, very good examples, Ford Motor Company. You work for Ford Motor Company for a specified amount of time, and they will give you a portion of your salary as a retirement package, and that's usually how defined benefit plans work. It's a pension plan if you think about it. So if Ford Motor Company did not adequately fund this pension plan well enough, what would end up happening is that Ford Motor Company has a legal liability in order to take care of their employees that they promised. In the defined contribution plan, if somebody does not adequately fund it by themselves, the person who bears the risk is going to be the owner of or not the owner of the plan, but it's going to be the employee that actually does it. So, very good example. If when I first, when I, and actually, let me put this a different way. When I was in the military, we had the 20-year retirement is what they called it. So as long as you made it 20 years in the military and you decided you wanted to retire, you would get a pension for the rest of your life. And, you know, it basically was one half of what we would call your base salary. And so if I made it to the rank of commander and I ended up retiring, I probably would earn, I would earn 50% of whatever my base pay was. Now, base pay for a commander at this point, it probably would have amounted to about $3,000 a month. So $3,000 a month for just breathing, not a bad way to go. Government also participates in what's called a defined contribution plan that's called TSP. TSP, which is called a thrift savings plan, very similar to a 401k. I would make contributions to the TSP as long as I wanted to. Now, in the military sense, they used to not match my contributions. Now they do. But when I was in the military, they did not match the contribution. So if I made a contribution to my TSP, that was my money. And then what would end up happening is that when I retire, I could take money out of the TSP and retire off of it. What ended up happening is, and obviously, if you think about it, the better of these two plans for me is going to be the defined benefit plan, because the military has a legal responsibility to pay me that money once I've made my 20 years. That's the requirement that they have. If I don't contribute enough money to my TSP, I'm stuck like Chuck. So there's nothing I could do. So when trying to figure out whether a company is going to offer a defined benefit plan or a defined contribution plan, oftentimes it comes down to risk and who's going to be making the contributions. And something that we're seeing, I should say, we saw a major shift going away from defined benefit plans to defined contribution plans. Usually the only people who offer defined benefit plans nowadays is going to be government, or it's going to be really, really large companies with a large union workforce. And that's kind of what we're seeing with that. Now, I know this isn't an HR class, but oftentimes what's going to happen is that if you're sitting in company meetings as a controller for a company, you're going to be asked, we're thinking about offering a retirement plan to our employees. What kind of a retirement plan do we want to offer? They're going to fall into these two categories. And obviously, from the company's perspective, the defined contribution plan is going to be a much better fit for most organizations nowadays, just because of the amount of risk that they have to take. So as I talk about here, defined benefit plans, it's fixed. It's based on fixed income a fixed formula. So it's average compensation over years of service, maximum benefit. In 2019 is the lesser of 100% of the employees' 3 highest years compensation, or $225,000. So in order for it to be a qualified plan, this is what it has to have. It has to have this maximum benefit in 2019 of 100% of the 3 highest years of compensation, or $225,000. Now, if you think about it, say for example you work for a union shop and you're a plumber, and you've been working for the company for 30 years. And at the end of your 30 years, you're probably, as a plumber, going to be making around $150,000 a year, believe it or not. And especially if it's a union shop setup, they're going to have it to where you've earned, what do they call it? It's, seniority increases. So what ends up happening is that your last 3 years, they could take the average of your last 3 years, say it's around $150,000, you get paid $150,000 up to $150,000 in order for it to be qualified. Now, more likely than not, people are not going to pay you 100% of the employee's highest 3 years of compensation. What they're probably going to do is it's going to be a percentage of it. So they're going to say, look, if you retire after 30 years of service with our organization, we'll pay you, 50% of your salary, or we'll pay you 75% of your salary, or how much ever it is. And I'm taking off my accounting hat and I'm putting on my HR hat for a little while. I don't think I've ever seen a company that does 100% of the employees' highest 3 years. Maybe it exists. I don't know. I'd be shocked. That seems like a lot of money to offer people for their retirement. And some people might say, well, wait a minute, Kevin. So you're going to retire. How are you going to survive if you're only receiving 50% of your money? Well, you have to understand that the most expensive times that people have is in their 30s and 40s and 50s because they have children. I don't know how many of you are going to George Mason that are having your parents fund your education, but that's a very large cost. The other thing that you have is, during the time that people are working, they're also saving for their retirement. So a lot of those big costs. And actually a third one I didn't even think about until 2 seconds ago. Your house. Usually, if you've been living in your house for 30 years, it's probably paid off. You don't have to make any more mortgage payments on it. All you have to do is pay the taxes, which roughly runs, depending on your area, $4,000 to $7,000 a year, which is very, very low cost, for how much you get on that. So I think that there's a lot of opportunity, for people to do very well with less money once they've hit the retirement year. So you don't need quite as much anyways. And then also, just because you're part of a defined benefit plan doesn't mean that you can't save for retirement in other ways. And people are highly encouraged to do so, and we'll talk about that a little bit later on. So from a company perspective, employers are going to deduct the liability as they contribute to the plan. And so what happens with these defined benefit plans, you have to actually hire an actuary to figure out what your expense is going to be. And so what will end up happening is that, based on what the actuarial assumptions does, they'll say, hey, look, every year they run an actuary, they say, okay, they call the actuary and they say, okay, run the numbers on us. They say, you have X number of employees. These are the age of your employees. This is how long we expect them to last. This is how much money you're going to have in order to be able to cover all of this. Now, companies can fully fund their pension plans, or maybe they don't. In order for it to maintain its qualified status, there is some funding that does have to happen. But, like right now, we have people being laid off left, right, up, and down. You're probably going to see some companies that are going to come back and be like, yeah, you know what, we're not going to fully fund our pension plan this year because we just don't have the money to do it. How is that going to affect retirement? If you're one of those who's going to retire in the next 2 to 3 years, it could affect you a lot. If you're one of those who's not going to retire for 20, 30 years, probably won't affect you that much because the company will have plenty of time to catch up. So as you can see, there's a lot of risk that the company has because you've already made the promise to that person who's going to retire in 2 to 3 years. Hey, you're going to get X number of dollars per year. And you're going to have to hope to God that the company can catch up on its funding. It's actually and this is part of the reason why a lot of companies want to go away from this. Right now, if the company's having a hard time, they can always just reduce how much they're going to match 401k contributions. But I mean, I don't even see a lot of that happening lately. But it's something that could happen. But not fully funding your pension plan bears a lot of risk that that companies just don't want to deal with. So usually with defined benefit plans, there's vesting schedules. It's usually either a 7-year grade or a 5-year cliff. In other words, you can't start working at a company and then 2 years later say, okay, now I want to retire with all my benefits. There's a certain amount of time that you usually have to work there. When they say the 5-year cliff, what they're saying is that if I work for you for 5 years, I'm fully vested in the company. And then, or I can do a 7-year graded, which basically says over 7 years, a period of 7 years, I'm going to receive a standard amount of vesting over a period of time. Now, some of you might say, well, what exactly is vesting? And vesting is the concept that when you go, it's a little difficult to talk about with defined benefit plans with a concrete example, but think of it as a 401k. If the company makes any payments to your 401k on your behalf, you have a requirement to work there, we'll say for 5 years before you do this. For the first 5 years, any amount of money that I make to your 401k that is a contribution, if it's a cliff vesting for the first 5 years, if you quit the company within 5 years, you don't get any of the money that I've made as a contribution. And so as a result of that, you'll lose that you lose that because you haven't fully vested before you left. Now, if I do a 5-year cliff, once you hit 5 year and 1 day, you can quit immediately after that, and all the money that I paid into there is yours. Okay. Yeah, I mean, it's still in the 401k. If you take it out, you're still going to be subject to penalties and taxes. But again, it's still yours. You can still retire off of it. For the 7-year graded vesting, periodically over time, the company contributions are going to become more and more legally yours. And so then what ends up happening is by the time you get to the 7-year, you'll be what we call fully vested, meaning all company contributions belong to you. This kind of works the same way in the defined benefit plan where it says, look, if I have a vesting schedule of 5-year cliff, what's going to happen is that you have to work for me for 5 years before you're going to be able to retire using your pension. And then you're going to be fully, once you hit the 5-year, you could retire at any time using the high 3, provided that you retire with certain criteria. So when they go back to this thing, what they're going to do is they're going to say, we're going to pay you a certain percentage of your salary based on your years of service. So maybe after 5 years, I'm going to be like, yeah, if you work for me for at least 5 years, we'll give you 10% of your salary. But then after you work for me for 6, we'll increase it from 10 to 11. And then maybe at 7, we'll increase it to 12. You see what I'm saying? So as you work more and more years, you get more and more of a percentage of your salary for the company. So what this really turns into, and again, taking off the accounting hat, putting on the HR hat, this becomes a great retention tool to make sure that people don't leave the company because they're like, I don't want to do anything to mess my relationship with the company because I don't want to lose my benefits. And it's a very, very useful retention tool. So then we're talking about distributions of defined benefit plans. They're taxable to the employees only when received. It will all be ordinary income. Unless if there's a portion of it that the employees themselves contributed to this plan, some of those contributions, when paid back to the employee, will not be taxed. And if you think about it, it's because you took money, you put it into the plan, it came back to you. They're not going to tax you twice, so to speak. And the way that we do it, and let me see if I can find this right here. There's actually a way to really see where this is. So when you go to retirement, you're going to receive what's called the 1099-R, R for retirement. And so what happens is that the gross amount of money that you receive is going to be put here as gross distribution. Generally, the taxable amount is either going to be equal to the gross distribution or it's going to be left blank. Very oftentimes, they're not going to do it. And if they do that, they're going to check this little box that says taxable amount not determined. Because what happens is they want to hand it off to the CPA, and the CPA's got to figure out what the taxable amount is. Okay. Then you have how much federal tax is going to be withheld. Again, if we talked about how all of this was, let me see here. We talked about how all of it is ordinary income. That's not always the case if there's a capital gain portion of it, but if that's the case, they'll report it here, and then and your tax software will take care of that. You don't have to worry about it. This box 5 is what I really want you to focus on, though. It says employee contributions or designated Roth contributions or insurance premiums. What that means is if I put money into this, my own money into my defined benefit plan, and that gets paid back to me, the person who calculates the 1099 is going to calculate how much of the money that I received in box 1 is actually my money coming back. So this box 5 is going to be a subtraction from gross distribution to determine the taxable amount. Sometimes your companies will do it for you. Some companies will just check this box and say, yeah, we don't know what the taxable amount is. They're just being schmucks. They could go ahead and they could figure this out on their own, but they just don't want to help you out. That'll happen from time to time. Okay. So that's how this kind of plays out. We're going to pass the examples. So defined contribution plans, very good example, and they talk about them here: 401k, 403b, 457. So a 401k is a defined contribution plan that's owned by a company. Here at Beta Solutions, we have a 401k. I'm sure many of you who are working on full-time jobs, you may have a 401k offered. I offer it to all my full-time employees. In fact, one of my staff is going to probably be offered it at some point. He hasn't worked the requisite number of hours yet, but that's going to be what's going to happen to him. And then the 403B. A 403B is essentially it's the same thing as a 401k, but it's usually 403Bs are owned by nonprofits and government agencies. So if you work for a state government, you'll probably have a 403B plan as opposed to a 401k. From the taxpayer standpoint, virtually identical. There's no difference whatsoever. On the legal reporting requirements, there's a little bit of a difference, and part of the reason why is because one of the problems that we tend to see in tax law is that 401k, sometimes there's a little bit of funny business that goes on. So they have additional reporting requirements for 401ks that they may not necessarily have for 403bs. But that we'll talk a little bit about that later on. But one of the big things about pension contribution, I took an entire course on this when I was at American University doing the tax masters. This is one of the few areas where not only are you dealing with Department of Treasury, but you're also dealing with Department of Labor. Department of Labor has a lot of power when it comes to the 401k, 403b management. And then the 457 is going to be a deferred compensation scheme that oftentimes is used to pay people who work for nonprofits. Okay. So usually they'll say employer specifies upfront contribution on employee's behalf. They'll match typically the employers match employee contributions. We'll talk about this a little bit later on, but there's 401ks come in a variety of flavors. One of the ones that they have is what they call the safe harbor. It's a very common plan. It's a lot cheaper, which is one of the reasons why they're very popular. But basically what happens is that they say on the safe harbor 401k, I'm required to either, and that's what we have here at Beta, I'm required to either match 2% of the employee's salary or I'm required to match 3% of the contributions that the employee makes. It's obviously cheaper for me to match the contribution of the employee because most employees aren't going to make a whole lot of savings or do a whole lot of savings with their 401k. So maybe that's what we offer. To be honest with you, I haven't made up my mind yet because one of my staff here is going to be the first one that's going to be on this, and so that's what I have to kind of think about here. Let's see. So annual contribution limits for 2019. We've talked about this for defined contribution plans. Is $19,000 if you're not 50 by the year end, and it's $25,000 if you're year end. And the employer contributions, it's limited to the lesser of $56,000 or 100% of the employee's contribution. Okay, so if when we say the employee's compensation, employee's compensation. So in other words, these are the limits that we have. So if my employee makes less than $56,000, obviously I'm not going to be able to make more of a contribution than what they actually make in their salary. And again, this is so that there's no funny business that goes on. And another reason why they do this also is to encourage business owners to actually pay themselves a salary, because if you pay yourself a salary, you got to pay self-employment tax. It's kind of all sort of a master plan if you think about it. Vesting, employee contributions vest immediately. If you put your own money into a 401k, it is yours. There's no requirements. You can take the money out. You'll pay a penalty by the IRS. The company can't charge you a penalty for taking out your own contributions, but the IRS does. They take a 10% hit, plus you'll have if it's a deferred taxation type scheme, you're going to have to you're going to pay taxes on all of that. Okay, so employer contributions on earnings. There's a vesting. These are minimum requirements, a 3-year cliff or a 6-year graded schedule. In other words, and when they say minimum, what they mean is that I can change this so that I can make it a 2-year cliff, or I can make it a 1-year cliff. I can't make it a 4-year cliff, if you see what I'm saying. So, and then the other thing is for, the 6-year graded schedule, I can't make it a 10-year graded schedule. I can make it a 5-year or a 4-year or a 3-year, but I can't make it more. I can't make it last longer. So, and again, the reason why they do that is they don't want employers coming up with a lot of funny business, and they want to make sure that everybody's on the up and up. Okay, so this is a typical 6-year graded schedule, and this is of course the 3-year cliff. Once you hit 3 years, you're automatically vested, so it ends up working out. Okay. Distributions are taxed as ordinary income. That is if you have a tax deferred plan. And when we say tax deferred, what I mean is that if you make a contribution to a 401k, it is a tax deduction for you. Now, you don't actually put that tax deduction on the tax return. The way it works out, and let me pull up another thing. So this is a Form W-2. What'll happen is that this is your W-2, and the way that you'll see what the difference is number one, if you make a contribution, you're going to put it here in box 12A, and it's going to be listed with the code D. D for and here they actually have they should have the instructions. Yeah, they do. So box, yeah, so 12 code D is elected deferrals to a section 401k or deferred cash arrangement. Also includes deferrals to a simple blah, blah, blah. But basically, if you make a contribution and it's a tax deferred plan, they'll put code D, how much you made, and then the difference between box 5 and box 1 will equal what is that number. Okay, because what happens is 401k contributions that you make are not subject to income tax, but they are subject to Medicare and Social Security tax. And so you'll have to make those you'll have to pay taxes on that. But again, 7.6% versus the income tax, I think it's a much better deal. Now, one of the things about this, though, you might say, well, wait a minute. Why did the government make this taxable for Social Security and Medicare wages? Well, when you take your 1099-R, there's no box here taxing you for your Social Security and Medicare amounts on a gross distribution of your retirement plan. So that's one reason why they don't allow it to be deducted for for those taxes. So early distribution subject to a 10% penalty before 59.5 years is still working, or 55 years and separated from service. In other words, if you're 55 years old and you've basically been laid off, you're allowed to take your withdrawals on your 401k without the 10% penalty. You still have to pay the tax, but you don't have to pay the 10% penalty. I actually had a client who came to me, and these are what they call 72T distributions. And the reason why they're called 72T is that it's code section 72 subsection T that allows for this exception to exist when you're taking a distribution from it. And sometimes you'll have a client who comes in and says, look, I just got laid off. I'm 56 years old. I'm going to start taking my 401k a little early. Can you calculate my 72T amounts? And I remember I did it. It was actually a pretty easy thing to do. The IRS is, when you calculate the 72T do the 72T calculations, it's a very basic process. There's a few ways that you can choose to go. I chose the most conservative because I wanted to make sure that the clients were taken care of for a longer amount of time, and that's also what they wanted. And so that's what we ended up doing. It actually was a very good engagement. It was a lot of fun. So required minimum distributions for the year which the employee reaches 70.5. Okay, so here's what happens. You make all these contributions to your 401k. And say, for example, you decide, you know what, I love taxes, I love accounting, I'm not going to retire. And you hit the age of 70. The IRS basically starts to say, look, we've given you all of these time. So we gave you the ability to deduct this from your taxes on the condition that when you retire, we're going to take taxes out when you do the withdrawals, but you're not making your withdrawals because you're just deciding you don't want to because you're still working. We want our money. And so the only way that they're going to be able to get their money is if they force you to start taking distributions. And so that's where you start coming up with this required minimum distributions. Now, something that this slide is actually inaccurate. It has been changed from the required minimum distributions used to be 70 and a half. However, now it's 72 years old. That is actually a major change. Okay. This right here is no longer 70 and a half. It actually needs to be, whoops. See if I can do this. Hey, I can draw. Okay, so it looks as perfect as it can using a tracker ball. So they've changed it to 72, and then they have also changed some of the other rules with this. And this was done by what's referred to as the Secure Act. Okay, the Secure Act actually, the Secure Act was passed recently. What ended up happening is, once they passed it, made several changes to a lot of different aspects of the retirement plans. But this was a big one, is that they took RMDs and moved it from 70 and a half to 72. Doesn't sound like a major change, but I've had a lot of clients that this is killing them because at 70 they're still feeling like they want to retire. They don't want to retire. They want to work. So there's a few things they can do. Now they can wait another year and a half. The one thing also about this, and I think we'll talk about this a little bit later on, there is an opportunity here that if you have a client who's required to do minimum distributions, we call these RMDs in the field, but they don't want it. They don't want the money. They don't want the tax hit. It's going to hurt them, and all that stuff. You can actually do a charitable contribution with this, where you basically say, hey, look, you can make a contribution to whatever favorite charity you want of your RMD, and then it's totally tax exempt to you. You don't get the charity deduction, but you don't pay taxes on the money as it comes out, which actually saves people a lot of money. Okay. So there's a 50% penalty on undistributed portions of RMDs. One thing I'll bring up with this also, and this is from another thing. CPAs sometimes will get engaged to do what we call RMD get out of jail free cards. The biggest problem that a lot of people have is that they don't know about the 70 and a half or the 72 years old. And then what will end up happening is that they don't make their RMDs because they don't know that they're supposed to make one. And the retirement plan fails to tell them. Or they tell them they do a letter, and people get they get a letter from their retirement company, and they say, yeah, okay, whatever, it's just junk mail because they keep sending me so much junk, and they throw it away. They come back and then the company says, hey, you haven't made your RMD yet, you're late. So what'll end up happening is the IRS will come in and want to take 50% of whatever you didn't make. They can come to you as a CPA. They can hire you to write a letter to the IRS that says, look, I've examined all the facts and circumstances, and this was purely not due to the employee. I mean, due to the client being greedy. It's not because they don't want to make the distribution. They just didn't know. And then this will actually get them away from the 50% penalty on the undistributed portion of the RMD. But in order to lose that, in order to keep that 50% waiver, they have to agree to set up RMDs going forward. And so if they ever get caught again, they're going to get hit with the penalty. So it's some potential opportunities if you're a CPA to make money. And actually, I picked up a couple of clients because of this. Then they found out how I work. They're like, yeah, we want to continue working with you. Okay. Traditional 401k contributions. Contributions are made with before tax dollars. In other words, like I said, you're going to get that, on your W-2, you're going to have box 5. Box 1 is going to have a difference, and that difference is usually going to be tied to whatever code D is. That's exactly how it works. So with 401k plans, there's a tax, it's tax deductible contribution, but when you take the money out, it is taxed to you. So, and some of you might say, well, why would anybody agree with this? Well, typically what ends up happening is if you're going to make contributions, you may be in the 32% tax bracket, but when you retire, you're going to be in the 12% tax bracket because you don't have a whole lot of income when you're in retirement mode. So what ends up happening is a lot of people will take they'll take this and they get a tax deduction at 32%. When they pull the money out, it's taxing them at 12%. Seems like a win-win for everybody involved. One of the disadvantages of this, though, is that we've noticed in the industry, what we've noticed is that people fall into one of two categories. Either A, they haven't saved enough, or two, they've saved way too much. And so what ends up happening is that people want to take this money out as they're doing stuff. And so sometimes what ends up happening is they make so much money that when they start taking money out as part of their 401k withdrawals, they don't, they may go from 30, instead of going down to 12%, maybe they go to 22% or 24%. Or if they're really successful in their 401k, maybe they stay at 32%. Sometimes it doesn't always work out. This is why this is really complicated stuff. This is why I always recommend people work with your financial planner, and always work with your tax specialist. So you guys who don't want to become tax people, that's fine. But those of you who are in the class with those who want to become tax people, make good friends with them so that they'll give you good discounted rates when you hire them, so they can retell you this after you've forgotten it in 10 years. Or you could come back to me and say, Kevin, I remember this 401k thing. Can you just tell me all over again? At that point, if I'm not a full-time professor, I'll probably be like, yeah, go talk to your financial planner. But your financial planner should be doing a lot of this stuff for you too. The problem is that a lot of financial planners, they get a rudimentary understanding of what taxes are, and so they don't always know all of the tax consequences. But that's okay. If you have a good CPA that you're working with who's doing your taxes, and you also have a good financial planner who's doing your financial planning, you should be fine. And that's what's the most important thing. Roth 401k plans, contributions are made with after-tax dollars. In other words, you don't get a tax deduction immediately. However, when you take the money out of a 401k Roth style, and so if you take money out of your 401k, your Roth 401k plan, what's going to end up happening is that you pay no taxes on the amount of money that comes out of that. I think if you're in your 20s, this is the way to go. Do the Roth 401k. It's a much better deal. And then there's also more opportunities to do various different other things, with your retirement savings. The better part about this is that with Roth 401k contributions, there is no required minimum distribution. Absolutely no required minimum distribution with this. And so you want to kind of keep wind of that if you have an opportunity to make a contribution. They're telling you here, employer contribution must go into a traditional 401k. That is partially part of the reason why they do that is because there's no way that they can make this tax deductible to the employer and retain the Roth 401k plan status. So that's why they want to make these things make it to where if you make the employer contribution, have to go into a traditional 401k plan. So you're going to actually have two plans. You'll have a Roth style, and then you'll have a traditional. But the traditional one, you're not going to make any contributions to. Your employer will make the contributions to that one. Okay, like they said, qualified distributions after you reach 59.5. Non-qualified distributions, earnings are taxable, but the money that you put in is not. Distributions of earnings are subject to a 10% penalty unless they are at least 55 and retired, or 59.5. Distributions from contributions are never taxable. Okay, I've actually picked up a client who I work with. He basically, he hired me to figure out how much of his distributions would be taxable and how much were not taxable, because the company that he was working with didn't help him. Basically, he cashed out a Roth IRA, which works the same way as the Roth 401k. He cashed it out in order to buy a house, and he wanted to figure out how much of it was taxable, how much of it wasn't taxable. Hired me to do it. He's been a client ever since. Been a client for 4 years, so it's been great. Non-qualified plans. Okay, so everything that we talked about up until this point is a qualified plan. Okay, non-qualified plans, they're going to allow you to do some discrimination, but there's also going to be a lot of problems with these. I'm not going to talk too much about these because non-qualified plans are very few and very it's very few and far between. So we're not going to worry too much about that. I doubt you're going to run into many of these, or if you do, it's because you're a specialist in this area. But the non-qualified plans, I wouldn't worry too much about, and we're just going to go ahead and pass on those. So individually managed qualified retirement plans. Actually, give me 1 second. I got to go take care of something here real quick. Let's take a 5-minute break real fast.
خلاص موجود.
All right, folks. Sorry about that. Yeah, sorry. I had a client who walked in to try to deliver some stuff. I told him he was not supposed to be here, but sometimes clients do what clients do. So this is actually a really good dividing point to kind of talk a little bit about the differences between what we call individually managed qualified retirement plans and then the ones that are like 401ks. So from a grand standpoint, the 401k is basically it goes into it. So 401ks are actually kind of like trusts that actually get formed. The problem with the 401ks is that they're actually managed by a trustee appointed by the company. So if you actually participate in a 401k, this is something you're going to kind of understand already. But the trustee is the one who's going to be making all the investment decisions for you generally. What will happen is that in a lot of 401ks, they'll give you options. And like, for example, when I was participating in the TSP program, I had 10 investment funds that I could choose from. 5 of them were basically linked, were basically linked to my my retirement date. And then I had 5 that if I wanted to do something special, like I had one that was like if I wanted to do, I'm trying to think, emerging markets was one of them. But I only had like 10 different choices. Okay. The thing is that you can't, as a plan participant, you can't go to the trustee and say, I need you to increase the number of choices. They're just not going to do it. And this is actually causing a little bit of a problem lately with 401k management is that the fiduciary responsibility that the trustee has, because they're not offering enough qualified choices for people to be able to take, what ends up happening is they may actually end up in some legal limbo as a result of that. One of the things I really like about IRAs, which stand for individual retirement accounts, you can choose pretty much anything that you want to invest it in as long as it's as long as it's a qualified investment. So, for example, if you want to invest, you want to take your 401k and invest, say, in IBM, and say, I want you to invest 100% of my money into IBM. They're going to look at you and laugh because they're not going to do it. Okay. You go to your IRA and say, I want to invest 100% into IBM. They're going to let you do it. Now, if the financial plan is worth their weight in salt, they're going to sit down with you and talk to you about diversity, but diversifying your investments. But legally, you can do that. You can invest in a wide variety of things. You can even buy gold in an IRA plan, physical gold that you can actually hold and touch, as the commercial likes to say. You can also buy land. You can buy real estate with your IRAs. There's a lot of restrictions in order for you to do that. But you can take your IRA contributions and you can do it in qualified investments like that. And then you have to make sure that you've got the IRA through a company that's willing to handle that. A lot of IRAs won't let you do investments in land just because they don't want to deal with the reporting requirements of it. But there's a few companies that specialize in this, and you can do that if that's something you want to do. So, again, there's two different types of IRAs. You have traditional IRAs, and you have Roth IRAs. The difference is, how's the money tax going in? How's the money tax coming out? With a traditional IRA, $6,500 per year is my maximum. I can make a contribution, get a tax deduction off of that. When I take the money out, it's 100% taxable to me, unless there is what we call basis in your IRA. We'll talk about that in a minute. But generally, money goes in tax exempt, comes out taxable. Roth IRA, it's currently taxed money, so my money is taxed going in, but when it comes out, it's 100% tax-free. Now, some of you might say, well, why would you do that, Kevin? You just told us that if you did that, why would I not take the tax deduction on 32% money, and then when I pull it out of the IRA, be taxed on it only at 12%? Why would I want to forego that? Well, one of the things that you'll see with Roth IRAs, not only is the money that's coming out that you contributed tax exempt, but so is all the earnings. And that right there is the key why Roth IRAs are a very, very valuable tool, particularly if you're in your youth. I've had people who have asked me, what do you think I should do? Should I do Roth IRAs? Should I do traditional IRAs? My answer always is talk to your financial professional. But generally speaking, and I've talked to a lot of other financial professionals about this, a lot of them are actually recommending Roth IRAs, particularly for anybody who's under the age of 40. Once you hit about 40 to 50, they start, it depends on circumstances. Once you hit 50, they kind of go, well, it's not going to make much of a difference at that point, whether you do traditional IRA or Roth IRA. It depends on your facts and circumstances at that point. So again, you would want to talk to a financial professional to make sure you choose what's best for you. And that's what you want to tell your clients, because we are not certified in a lot of those decisions. So for example, if somebody asks me, what do you think, what kind of investment advice do you give clients? And the answer is none. I don't give them investment advice. That's against the law. I actually can't do that. So the first answer I always tell them is talk to your financial professional. Now I can give them advice from a tax perspective. I can say, hey, if you want to choose whether you're going to contribute to a traditional IRA or Roth IRA, I'll tell you the tax consequences, and that's perfectly okay. As a CPA and a tax professional, that's my job. But if they're going to ask me when in my IRA, what should I invest in? Not allowed to tell them. Okay. So this is what they talk about. 4 IRA contributions are generally not allowed if you're in an employer-sponsored plan. That's not completely accurate. The contribution that you can make if you are not part of a plan basically, if your combined AGI is less than $123,000, you're going to still be able to make a contribution to an IRA if you want to, and you're part of an employer-sponsored plan. For that's just kind of the way that it works out. I think that what they're saying here is because, like, if you make more than 123, which married filing joint, I mean, you think about it, each of you is probably making about $62,000 a year. That's not very much money, so you're gonna hit that plan very quickly. But I mean, again, I think that you need to take a look at it from your facts and circumstances before you make any calls on that. Also, they say, so for single taxpayers, deduction allowed if participating in an employer plan, but income is below certain thresholds. That is true. And the thresholds for the single people, excuse me, for the single people, the $74,000 is the total phase out when you've got it. Yeah, so a phase out that applies if covered. Okay, so that's if you're covered by that. For married filing joint people, if you are, like I said, if you are covered by a retirement plan, the phase out for married filing joints can be $123,000. If you're not covered by the plan, it's $203,000. That's a big difference. Okay. So on the, again, you can contribute up to a certain amount. It's either $6,000 or earned income. If you're 50 years or older, the limit is $7,000 earned income because you got a $1,000 additional catch-up provision. For married taxpayers, is allowed to participate in plan below certain thresholds. We already talked about that. Lesser $6,000 of both spouses, reduced by other spouses' contributions to the IRA. And so what they ended up doing, and here's why the wording on this is a little weird. Several years ago, one of the things that they noticed was that, if you have a one income family where, one spouse goes out and works and then one stays home and raises kids, one of the things that they've noticed was that, particularly in divorce situations, it was very, very hard for the spouse who wasn't working. And part of the reason why is because they would have no retirement savings because they weren't allowed to make contributions because it was always based on your earned income. Well, that spouse had no earned income. So Congress acted, they passed what they called the spousal IRA contribution that basically says, look, if your spouse is a stay-at-home, mom or dad, they can use the other income of the other spouse in order to make a determination as to whether they can contribute to an IRA or not. And so what ends up happening is that allowed non-working spouses to basically do that. So that's important. I just want to make sure that you guys understand why the wording on that is a little weird in that sense. And again, if you're over 50, the limit is actually $7,000 or your earned income of the spouse of the spouse. Make non-deductible. Oh, okay. So here's the one thing that I've always kind of talked to clients about when talking to them about IRAs. Even though you're not allowed to get a tax deduction on the IRA, like it says here, if you make too much money, you're not going to be able to get the tax deduction. Basically, if you can make a non-deductible contribution to an IRA. Now, some of you might say, why in the world would I do this? Well, just because you don't get the tax deduction doesn't mean you shouldn't save for retirement. There's a lot of people who end up doing this. Now, something that we also can talk about here, and just because we're a little short on time, I'm not going to get too much into it. This is actually a way that we can do. You can make a contribution to a Roth IRA if you're not allowed to, but I'll talk a little bit about that if we have some time. But it's what we call the backdoor IRA. So in other words, if you make too much money to make a contribution to a Roth IRA contributions are not allowed once your income is more than $203,000. Say you got a client who makes $300,000 a year, and they're married, filing joint. They can't make a contribution to a Roth IRA, but they can make a non-deductible contribution to a traditional IRA. Bill Gates can make a contribution to a Roth IRA. To a traditional IRA if he wants. He just doesn't get a tax deduction for it. Okay. But he can make the contribution anytime he wants. Now, he'd be silly to do this because he's got more money than I'll ever be able to spend in one lifetime. You know, so he can make the contribution if he wants to, just there's no deduction. So what they do with the backdoor IRA is they say, look, you make the contribution to the traditional IRA, it's non-tax deductible, then you roll it over immediately into a Roth IRA. That's what they call the backdoor contribution. So what ends up happening is that, you know, you go to your financial planner saying I make too much money, which of course they're going to be very happy to take you as a client, but I need to make backdoor IRA contributions. It's a set process. They take care of it. You don't have to worry about it. All right. You do have to contribute by April 15th of the subsequent year. So for this tax year, actually, I think this has been extended to July 15th because of the extension that they gave, but I'm not too sure about that. I'll see if I can find an answer. But basically, you must. So say, for example, and you might have to say, why do they allow you to do this? And the reason is that say you get to the end of your we'll talk about for 2019. You get to the end of 2019, you haven't made any IRA contributions because you don't know what your income is going to be like. Okay, so you get done, you file your taxes, and you go, oh my God, I realize I owe money. Well, instead of sending some of that money off to the IRS, you can make a contribution to a traditional IRA, and it has to be made before the tax deadline of the tax return. And if you make it by then, you're going to get the tax deduction in the year that you're talking about, which in this case would be 2019. It's a very valuable tax saving strategy that you could recommend to your clients. Most of the clients that I have here will qualify for this because all their contributions are non-tax deductible anyways. But some of our clients that we have, I have a few of mine that are still pretty young, that this is something that we do recommend to them. So with your IRA, traditional IRAs work just like 401ks, if you think about it. Roth IRAs work just like Roth 401ks. So there's, you know, the only difference that we have is these certain exceptions. So this 10% penalty before age 59, what happens is if you take a withdrawal from your IRA and you don't do it for a qualified reason, you're going to get a 10% penalty. Certain exceptions exist for IRAs that don't exist for the 401ks. One of them is if you have medical expenses. So if you put down, if you say for example, I have, you know, God forbid, I have coronavirus, I don't have health insurance, I go to the hospital and they're going to send me there, and it costs me, you know, $4,000 to get healed up or whatever. I could take the money out of my 401k, or I'm sorry, out of my IRA, not my 401k, but I'm out of my IRA, and then I can use that money in order to pay those expenses. Now, some of you might say, well, wait a minute, why do they do this out of IRAs versus 401ks? I don't know. Congress made these rules. It's kind of ludicrous in my personal opinion. Now, my thought would be if you have the ability to do this, roll some money over from your 401k to a traditional IRA and then take the money out. That way you can get the medical expenses. And you know, the amount of money taken out of the IRA, and as far as timeliness goes, it just has to be done within the same calendar year. So as long as it happens in the same calendar year, IRS doesn't care, because as far as they're concerned, it's like money from one pocket to the next. Okay. Insurance premiums, same thing. Also, your first home, you can take up to $10,000 for your first home as a distribution from your IRA to pay for your house. So there's some definite reasons why you may want to do that. Same as okay, it's qualified plan. Yep, non-taxable percentage equals non-deductible contributions divided by balance of the account. This is actually a very common thing that we run into. Somebody takes money out of their 401k. We got to figure out how much is taxable and how much is not taxable. And actually, with one client, I have a massive spreadsheet that I have to manage for them in order to do this. Roth IRAs, non-deductible contribution. Again, money's tax going in, not tax coming out. So it's non-deductible contributions, and then you don't have to worry about it. And again, the phase out for the Roth IRA is going to be at just had it here. $203,000 is going to be the max. The phase out begins at $193,000, but totally phases out $10,000 north of that. Distributions for Roth, like you said, it's never contributions. Distribution and contributions are never taxed. Qualified distributions of earnings from the Roth are not taxed. This is the major benefit for them. Okay. These are some, must be open. Okay, so first of all, the account must be open for 5 years to be able to receive qualified distributions, and must have one of these factors that takes place. So again, very valuable tool in order for savings. So non-qualified distributions are subject to the 10% tax. There's no minimum distribution requirements, which is really good. Rollover from traditional to Roth, tax consequences. What happens is that you will be taxed on the money that gets rolled over. Some people might say, why would you do this? Well, if we know that you're going to have a much higher tax bracket going forward, we may want to do this at this time. Take the tax hit now, or we can sometimes we actually do this when people are unemployed. We're like, okay, now you can afford to take tax hit, because if you're not making any income for 6 months, your tax bracket's going to go down significantly. Maybe we do some rollovers at that time. Could be a good benefit for a lot of people. But again, you got to be able to make enough money in order to afford the tax. Plans for self-employed people. Just kind of going over these really quickly. You can do a SEP IRA or an individual 401k. We call these solo 401ks in the industry. SEP IRA contribution is the lesser of $56,000 or 20% of the net Schedule C income deduction for employer's portion. Employer's portion is 50%. So if as a self-employed individual, I can make a contribution of 20% of my earnings, which is good, So if I made $100,000, I take 20% of that, $20,000 contribution, and then here's the best part: it's tax deductible immediately this year. I like to call these IRAs on steroids for most of our self-employed people, because if they're the only employee, then this is a great way for them to make money, or save money, and then also make money for their retirement. Must provide a plan to employees if taxpayer has employees. This is the only downside to the SEP IRA, is that if you have employees, they're allowed to participate in it as long as they work for the company within the requisite amount of time. Okay. Solo 401ks, contribution limit is $56,000 or 20% of the net Schedule C income plus $19,000. Okay, so you can solo 401ks are a wonderful, wonderful tool in order to be able to take care of a lot of this stuff. I highly recommend their use to our clients often. And then these are the examples. The last thing we'll talk about today is the Savers Credit. It's a credit for contributing to a qualified plan. My clients never qualify for this because and when I tell you the limits, you'll understand why. I'm trying to figure it out where it is because I don't ever look this one up. Savers Credit. Where is it? I want to say, Savers Credit. Here it is. Married filing joint, $64,000. So if you have if you're married filing joint, you make $64,000 or less, they'll give you this credit. And if you're single, it's up to $32,000. As you can see, not a whole lot of people qualify for this. Especially people who are hiring CPAs to do their taxes. I just bring it out to you guys because I think, while you guys are students, this is a great way to lower your taxes and do something for your future going forward. And so this is what they have here. Applicable percentage. If you're a married filing joint filer, you can get a tax credit equal to 50% of whatever your tax liability is. If you're between 38 and 38,000 and 41,500, you can get a 20% credit, and then 41.5 all the way to 64,000 is a 10% credit. So again, could be useful and all that sort of stuff. All right, so I've got about a minute to spare. Any questions? All right. Again, let's see. For some reason, whoops, I accidentally wanted to do that. Okay, there we go. If you have no questions, that's fine. Again, I will see you at 7 o'clock. This is going to be a discussion. I will ask you to, if you want to ask me a question, you want to do it by private, that's fine. Just be aware, I'm going to repeat your question, obviously. Will I be uploading the lectures on the Blackboard? Are you talking about the PowerPoints, or are you talking about the recordings? The recordings, I'm not. I made a decision not to do that because of something, but I'm actually in talks with one of the other teachers about whether we should be doing that or not. I'll try to have an answer for you later. The concern I have with doing that is I know what's going to end up happening. I'm going to be talking to myself. Basically, there's going to be like one person who shows up at 7 o'clock, and that's it. And then the rest of you guys are just going to wait for the things to come out. I know that with the distance learning, the concern that they have is that, for the accreditation, class has to be done. And then, there has to be a way that we can monitor to make sure that people are actually paying attention to the class, or at least showing up to the classes. So that's kind of the requirement that I think that they're running into. But again, I'm going to talk to one of the, I'm talking to one of the professors. I'll see what their thoughts are on this. So, hopefully I'll have some more information later on today. Okay. If there's nothing else, I will wish you guys well, and stay healthy. Thank you.